Welcome to Fall into ETF Investing. On today's special episode, our panel of guest speakers will be discussing the Dividend Advantage.
Welcome to ETF Market Insights. I'm Erin Allen, and this is Danielle Nezel, and we're your hosts of ETF Market Insights. And today we're really excited to be kicking off our special edition Fall into ETF Investing.
Erin and I, we are out of our home offices. We're right here in studio together. We're also talking with experts in the industry. We're bringing everyone together to bring you, the do-it-yourself investor, a fantastic educational experience. Here at ETF Market Insights, we're all about providing DIY investors the tools they need to navigate these markets and manage their own investment portfolios.
Just a reminder before we do get started that we're not providing you investment advice or investment recommendations today. As Danielle mentioned, our show is all about providing education for DIY investors.
Our next session is all about dividend investing and why dividend ETFs make a lot of sense for do-it-yourself investors.
Our host for today is Sejal Patel. She is the host of Strictly Money, and she is a personal finance enthusiast and also an advocate for women in investing. So Sejal, I'll turn it over to you.
Thanks, Erin and Danielle, for having me back on the channel. Great to be here. Welcome, everyone. In this episode, we're going to talk about a very popular topic, dividend investing. It's become a go-to for a lot of do-it-yourself investors, and for many good reasons. What's really made dividend investing accessible are exchange-traded funds. However, not all ETFs are created equal. We have two stellar experts who will break down how to analyze dividend ETFs and the different strategies they use in the market. Plus, we'll discuss how these ETFs can fit into your overall investment game plan. I'm joined by Valerie Grimpa, a true pro when it comes to ETFs. Valerie runs the global ETF sales and strategy team at RBC Capital Markets, and she also works closely with ETF issuers to help facilitate ETF trading and create markets for their ETF products. Chris Heeks also knows the ETF space inside and out. Chris is a portfolio manager for equity-based and derivative-based ETFs with BMO and brings more than 14 years of experience in the investment industry. Welcome both.
Thank you for having us.
So Valerie, I will start with you. Great. Dividend investing is very popular with investors. Why do you think that is? Maybe run through the benefits.
It's really easy to see why the dividend style factor is quite popular, and it should be popular kind of throughout market cycles. And that's because of one key feature, and that is total return. So, they kind of are this perfect intersection if you look at dividend paying companies, in that you get this nice equity feature. So you're participating in the market, you're hoping for that price appreciation, that capital gains upside. But then you also got this element that's a little bit fixed income-like in nature. You're getting this regular stream of income. And then combined as a total package gives you this beautiful total return. And then the other thing I don't want to take light of is the compounding factor. Mm-hmm. And it shouldn't be unappreciated. If you look at S&P 500's return over the past 35 years, over half of that total return is due to dividends and reinvesting dividends along the way. So it's super powerful. And then the last thing I will mention is that they also I think we'll get into some of this in this discussion, but it can lower overall risk. This is intuitive. Mm-hmm. If you think about the companies out there that are paying dividends, they're usually in mature businesses. They have obviously got cash on hand, and they also usually have a lower market beta.
Chris, Valerie touched on a lot of wonderful points and benefits, but I think a lot of investors are wondering whether holding dividend stocks makes sense today, because we are in a high inflationary environment, high interest rate environment. There's a lot of market volatility. So how have dividend performing companies or dividend companies, how have they performed?
Well, I think it might prove to be, first of all, great to be here, but I think it might prove to be a bit of a tale of two cities. What's happened so far this year and what are we looking at going forward? If you look at the start to 2023, the NASDAQ is up 35%. So despite these pressures, the market has treaded higher. But, as we move into fall, we're seeing that concern again. It's much more reminiscent to me of 2022, which was when we initially saw those rate increases go up substantially from essentially 0% interest rates to 5%. So we're seeing the pressure of that. We're seeing this messaging of so-called, higher for longer in terms of interest rates. Mm-hmm. And that's where I think, and we'll get into it, I know, but when you're talking about investing in high quality dividend companies, I think that part's very important. Not all companies are made the same, but high quality dividend companies going to offer that ability, yes, to pay an attractive dividend yield, but also to mitigate risk as we go into fall with certainly a little bit more volatility in the backdrop. So far this year, dividend ETFs would have underperformed, would have been more of a growth story, more of a tech story. We remember AI earlier this year. But I think as we move forward and start to look at turning the calendar into 2024, we're going to look at, I think, fundamentals, cash flow and sustainability being more important in the market. And that's where I think dividend ETFs can play a role in portfolios.
So Chris, for those who are looking at dividend stocks, why do ETFs make sense?
Well, there's a lot of reasons that ETFs can help, but in dividends, I think the number one thing is building out, it's kind of boring, but diversification. And if you look at our dividend ETFs at BMO, in Canada, we've got 50 names. In US and internationally, we have 100 names. ETFs can offer that ability to build a more diversified portfolio. When you're looking at dividend-based investings, I think, if you ask yourself, what's the risk inherent with dividends? Well, I think the risk is, some companies will look attractive, meaning they may have a high dividend yield, but that may pose extra risk. Higher yield does not mean it's going to be a better investment. And so when you're looking at dividend ETFs, you want to look for methodologies like BMO's methodology that does put a focus on not just dividend yields, but what's the fundamental strength, what's going to be the ongoing ability of companies to maintain and hopefully grow that dividend over time. So a good dividend ETF can take that into account and build broadly diversified portfolios. Obviously, if you're just investing in one or two or three stocks, your fortunes are very much tied to those outcomes. Building a diversified portfolio can offer better overall robustness in portfolios. And then ETFs give you those other classic advantages of ETFs, the one ticket solution, intraday liquidity that can be traded during market hours, transparency, low cost, all the things we've kind of come to love with ETFs overall, that also apply to dividend ETFs as well.
So Valerie, how many dividend ETFs are there in Canada?
Yeah, by our count, there are just over 100 dividend ETFs in the Canadian marketplace alone. So it's quite saturated. We like to think of dividend ETFs in 4 different buckets. So we have dividend quality, dividend growers, high yield, and then also covered call products, which are written on top of dividend strategies. And what we've seen this year is a bias towards the home team. So we're seeing a lot of buying of Canadian dividend ETFs. And we've also seen a lot of interest in covered call strategies as well.
Okay. Then from a market maker perspective, what are you seeing in that space? And I should probably clarify for those who don't know what a market maker is. They play a very important role to ensure that there is efficiency in the market and liquidity as well.
Yeah, exactly. So we're out there every day posting both bids and offers, and then also help, the key kind of functionality of ETFs is the kind of create, redeem ability. And so we're out there trying to facilitate those tight spreads and kind of the tradability and the liquidity of ETFs. And so kind of what we've seen so far this year, again, is kind of this bias towards quality. Chris touched on this earlier. Dividends as a factor, as a style, have underperformed a little bit, especially if you benchmark it against the US names, because it's kind of had a growth bias. But like I said earlier, there has been a lot of interest in Canadian dividend ETFs. And I think, again, that's just kind of showing investors now are positioning towards kind of what is likely going to be an uncertain 2024. There's lots of talk. Is it soft landing, hard landing, bumpy landing? Kind of the consensus on our desk as we talk to people is that they're isn't a consensus. And so I think people are kind of thinking a little bit more defensively and are trying to position that way. So if I'm thinking about my tactical Canadian allocation, maybe I want to have a quality dividend tilt to that for this time.
So Chris, lots of ETFs, as Valerie explained, and different types of ETFs. What are some of the considerations investors need to make before buying a dividend ETF?
Well, look under the hood, do your due diligence. Always these, things are very, very important. So, to me, the number one thing again is the, if you're buying it with the expectation of lower risk, and I think that's a good way to look at it, blue chip companies should be more mature, more stable. Just take a look at that methodology and make sure, you're comfortable with it. I think Valerie, that way of decomposing it into just higher yield versus ones that look more at the quality or the fundamental strength. That's a good one because, what you wouldn't want to do is go to a high yielding dividend ETF thinking that's a safe play when actually you might be getting exposed to more risky companies. So, if part of the, thesis, if you will, of buying a dividend ETF is that we're late in the cycle, we're looking at a landing of some kind, most likely, right? Or there is the no landing, but what's called a landing of some kind, and you want to be defensive. Look at that methodology, and so that's one thing you can look at. And the other thing I think about is as an investor, look at the company and ask yourself who can you trust as a company to give you the help you need, the resources and the support. Who's invested in the Canadian market. Right. And BMO's always had a great advantage, in my opinion, in being we're Canadian made and we're made for Canadian investors. So that's another thing I think you can ask yourself when you're doing due diligence is who's going to support you. And of course, we want to be doing that at BMO. And if we're not, we certainly want to hear about it. So.
And if I could just add to that, Chris, we just talked about there's 100+ dividend ETFs in Canada. It is so important to do that research, look under the hood. I encourage everyone that we speak to look at the holdings list, understand what you're buying. If you're looking down a list of 100 ETFs and you're kind of sorting by highest yield, there are a lot of reasons why you maybe shouldn't just jump to that top name on the list that's showing this high yield number. Right. And we won't get into the financial math behind that, but this could be signs of distress or companies that are maybe a little bit more unstable. And then the other point I would mention is kind of, again, understanding the nuances around the terms dividend quality, dividend growers. On a lot of dividend growers lists, you will see companies like Microsoft and Apple. These aren't traditionally thought of when you're thinking of dividend paying companies, but they have stable dividends that they are growing year after year after year. So they kind of belong on this dividend growers list. And it's not just boring kind of traditional companies that we think of like utilities in the kind of the holdings list. So definitely do your research.
Makes so much sense. So when you're picking an ETF, a dividend ETF, that's one thing. Making sure that it fits into your overall portfolio is something else. So Valerie, what are some of the things that investors have to think about?
Yes, absolutely. So we like to think that the dividend factor can kind of belong in any portfolio and can be used as a core holding, a core strategy, something, again, as you're thinking about risk profiles and kind of income generated that investors and advisors can kind of allocate in a certain amount to this dividend style. We also think dividend style can be used as a tactical bend as well. We talked about this earlier. We're kind of going into this period of uncertainty. People aren't quite sure what 2024 is going to look like. The RBC Capital Markets view is that we're kind of looking into a period of low economic growth. So kind of how do you move puzzle pieces around the edges of your portfolio with a tactical tilt? And maybe going into 2024, we might want to consider adding a dividend strategy for that consistent income and kind of the more stable cash flows and the lower market beta that dividend paying companies are known for.
Speaking of strategies, Chris, what is BMO's dividend approach? And why is it important to emphasize sustainability and growth when you're looking at strategies?
Yeah, for sure. So there's a couple key points to what we look for in our dividend ETFs. The first one is we'll look at the 3-year track record of growing dividends. And in particular, we're looking for companies that are growing their dividend or maintaining the dividend we're not looking for dividend cutters or non-dividend payers, which seems pretty straightforward. But the reason why is, again, it goes back to return and risk. And companies that are growing their dividends and maintaining it adequately tend to have a better risk-adjusted return than companies who have cut the dividend, or even companies that aren't paying a dividend. Those companies can have more risk associated with them. So that's number one. You have to be paying a dividend. You have to be growing it or maintaining it. But again, then the second big component, I'd say, is looking at the sustainability of that dividend. And that's where you got to go under the hood and start looking at the company fundamentals and looking at what analysts think about the company in terms of the forward-looking fundamentals. So, you can find all this information on our website. Can't go into, every number, but we're looking at how much dividends are you paying versus how much cash flow are you generating. And so on both a historical and a forward-looking basis. And so as an example, if a company is generating $100 of earnings and paying out $50 as a dividend, much like the Canadian banks, so we're at a 50% payout ratio, that's just fine. That's sustainable, right? If a company is generating $100, they're paying out $120, that's not sustainable. And they might be able to do it for a time, but eventually they're going to have to cut the dividend. And it's probably saying there's something risky with that company. So for us, and I think where you can really harness the benefits of dividends overall is, again, being in these more sustainable, high quality dividend payers. And you have to go look under the hood. So those are kind of the two big screens that will narrow down our investing universe. And then our weighting factor is on total dividends. And total dividends is our dividend yield of a company times a market cap. And that's the total dividends that a company is paying out. So we get a tilt towards higher dividend paying stocks. We also get a tilt towards bigger, more blue chip, more kind of larger companies. And so in our methodology, that's where a Microsoft or an Apple can make the portfolio, because although the dividend yield's 2%, it's a larger company, it's more stable, and it can make the portfolio based on that. So we do have that tilt towards higher dividend yield, but we also have a tilt towards liquidity and large cap and kind of that blue chip aspect that we really think, most clients, when they go into dividend ETFs, is what they're looking after. And so that's kind of our, that's our construction in a nutshell, and, really just designing to get the best overall client experience. Everyone wants income, but we want to do, have a sustainable, to your point, total return track record at the end of it as well.
And I'd also just add too, is that Chris, you did a great job of really simplifying that. But I would highlight there's so much nuance that goes into this and goes into that kind of stock selection. What is the basket? What is the ETF holding? And there are just so many levels to this. You really need to kind of pay attention and make sure you're investing with a team that you trust.
Absolutely. Valerie, Chris, I want to thank you so much for your insights today. I certainly learned a lot, and I'm sure our viewers did as well. Well, that covers off our session. I'd like to thank BMO ETFs for continuing to host these educational segments for do-it-yourself investors and helping them become better informed. Have a great day.